kind of trade. But let's focus on the personal finance corner. Hemant Rustagi of Wiseinvest Advisors is our guest today. Hi Hemant, good afternoon. And let me straight away go across to our first caller. It's Bhanu Pratap, who's called us from Mumbai. Hi Bhanu.
Hello.
Hello.
Yes, my question is, what is the systematic transfer plan and how could one benefit from investing in this plan?
Okay. Hemant?
Systematic transfer plan, or STP as it is popularly known, is actually a mechanism whereby one investor can invest or transfer money from one scheme into another scheme of the same mutual fund. It's basically ideally suited for those investors who may have a lump sum money to invest but may not like to invest the entire money at one go, especially when the intention is to put money in equity or any equity-oriented balance fund. Now what typically happens here is that there are debt-oriented funds like liquid fund and ultra short-term fund. So when you opt for STP, you invest in a debt fund, like I said, a liquid fund or a ultra short-term fund. And while making an investment, you give instruction to the fund house saying that I would like to invest a fixed sum at a predetermined interval into an equity fund. So what happens is, instead of money coming out of your saving bank account, the money will come out of the scheme where you have invested the lump sum, and then the money will go systematically over a period of time into a chosen equity fund. In fact, I would say that there are quite a few advantages of investing through STP. One is that these liquid fund and ultra short-term funds have the potential to give you higher return than what you usually get from a saving bank account. So you benefit in terms of higher return there. And second is, like I said, as the name also suggests, it's a transfer plan, which means that you are actually following a disciplined approach of investing into an equity fund or a balance fund systematically, which means that you benefit from averaging. The third advantage, or I would say, is that if during the period of STP, if there is a steep fall in the market, you can actually benefit by switching a larger amount into the equity fund. But I must add here that this has to be done selectively, because when we talk about volatile markets, there is a temptation to invest a larger sum every time the market goes down. So one has to be a little careful there. But there is definitely an opportunity for you to invest a larger sum and benefit from the fall in the market.
Okay, we also have an SMS query, so let's get that in quickly. From Rohan Singh, who writes to us from Punjab. He says he's invested in a mutual fund having a lock-in period of 3 years and now wants to withdraw his money. He would like to know what are the penalties for a premature withdrawal. Hemant?
Well, actually, it would depend on the kind of scheme is invested in. If the money has been invested in equity-linked savings scheme, or ELSS as they are popularly known, it is not possible to take out money during the lock-in period. Because ELSS is one of the options to save taxes for investor under Section 80C. And like every other option, this scheme also has a mandatory lock-in period. But in this case, the lock-in period is 3 years. So if it is ELSS, he cannot take out the money. He'll have to stay invested for the entire lock-in period. But if the money has been invested in a plain vanilla closed-ended fund with a lock-in period of 3 years, then definitely there is an option to exit. SEBI has made it mandatory for all the mutual funds to list their closed-ended fund. But I must add here that liquidity provided through listing on the exchange is not a very efficient method through the exchange. The reason for that is that you must have a demat account to be able to sell your unit. So if you are an investor who is not usually investing in equity funds, so it becomes an issue for you. So you have to open a demat account for that. Second is, it is very difficult to find a buyer, and even if you find one, usually you will end up investing at a very deep discount to NAV. So I think that's why it's very important for any investor who goes in for a scheme which has a lock-in period to make sure that you're very clear about your time horizon, and you usually will not require that money. And that's why we always recommend that whenever you're going for this kind of investment or any investment for the long term, create an emergency fund so that you can handle these kind of exigency without disturbing your investment.
Thanks, Hemant, for taking the time out and joining us. But with that, we need to wrap up the show.
MCX Stock Exchange, India's new stock exchange, presents Markets and Macros.